Hi, I am Gautam Duggad, Head of Research at Motilal Oswal. I'll be discussing our thematic report on contrarian investing. Amongst the multitudes of investment frameworks and styles which have worked, one of the most interesting and least popular is contrarian investing. Going against the grain and herd is not a common natural human instinct, be it investing or any other domain. In this report, we have attempted to highlight the key tenets of contrarian investing from the perspective of Indian markets. The objective of this report is to develop an application toolkit for India. We've covered two major themes based on contrarian investing: consensus ratings and valuation multiples, and have demonstrated the success of contrarian investing in India. Contrarian investing is defined as an investment strategy that is characterized by investing in stocks which are out of favor with the crowd or market. A contrarian investor believes that certain crowd behavior like irrational exuberance, overreaction, and human limitation as a forecaster can lead to certain mispricing in stock market, which can be exploited in a consistent and systematic manner. There are various facets of contrarian investing. Investor overreaction hypothesis, which states that investors overreact to certain events in a consistent and predictable manner. There also exist several biases: overconfidence bias, availability bias, anchoring, and hindsight bias. The chart of Nifty earnings forecast and actual delivery in this slide highlights the human limitations as a forecaster. In this report, we have discussed contrarian investing in two buckets. One bucket is based on consensus rating and other based on valuation multiple. Within the consensus rating bucket, we evaluate four patterns. The first pattern is popularity as selection criterion. This is basis Bloomberg consensus rating. It assigns 5 points for every buy recommendation, 3 points for every hold recommendation, and 1 point for sell recommendation. A consensus rating is arrived at by taking the average of the scores. Our analysis suggests that neutral to moderately popular stocks have performed the best, whereas least popular stocks perform the worst. Quintile 4, which is the quintile of neutral to moderately popular stocks, has outperformed the rest 4 quintiles. The best returns in our study has provided by stocks where consensus rating has changed from net sell to net buy. Such stocks have delivered average 24% returns over the 12-month period after the rating has changed from net sell to net buy. Second pattern we have analyzed is consensus sale. Consensus sales are significant underperformers. Given the scarcity of sale ratings on the street, only 15% of the stocks are rated sell. Such recommendation usually perform in line with recommendation given the scarcity. The next pattern that we have analyzed is consensus buy rating. After our analysis, we derive the conclusion that consensus buy ratings has not provided great returns. The second bucket we analyze is basis the valuation multiples, and we have chosen two relative valuation multiples which are most relevant from India perspective: price to earnings and price to book. For every quarter starting with quarter ended December 6, we have divided the BSE 100 constituents into quintiles based on PE ratio and evaluated the returns delivered by each quintile. Quintile 1 is composed of the highest PE stocks, while quintile 5 has the lowest PE stocks. We found that low PE stocks outperform the high PE stocks by a huge margin. The margin of outperformance increased with trailing PE as the criterion for forming the quintiles instead of 12-month forward PE. Low PE stocks based on trailing earnings returned 18.5%, which generated an alpha of 8.3% over BSE 100 benchmark on annual basis, almost 1.7% more than low PE stocks based on forward estimates. We also highlight the high dividend yield which supports performance of low PE stocks in the bear phases. We performed the same analysis for price to book bucket. Here the conclusion is meaningfully different. Over the decade, low price to book stocks have actually underperformed the high price to book stocks on forward multiples and outperformed the high price to book stocks on trailing basis. The alpha generated by low price to book stocks was much lower than the other stocks. However, low price to book stocks led all the other quintiles on the return charts for majority of the decade. So, in a nutshell, a review of the performance of contrarian themes based on relative valuation metrics suggests that price to earnings ratio is a better predictor of returns as compared to price to book ratio. Having done this detailed study and analysis, we highlight some contrarian buy and contrarian sell ideas from our universe. Some of the key contrarian buy ideas are Axis Bank, Bajaj Auto, Coal India, Idea, Punjab National Bank, REC, Shriram Transport Finance, Sun Pharma, Tech Mahindra and Colgate. Some of the key contrarian sell ideas include Asian Paints, Bajaj Finance, Aisha Motors, Gale, Havells, LIC Housing Finance, IOC, Voltas and Escorts. These recommendations did not necessarily be in consonance with our regular analyst ratings on the stock. We have also applied this framework on three sectors to study the hypothesis. Firstly, on metals, we have backtested the hypothesis. Based on that, we conclude that the framework would have worked quite well on metal sector in early 2016 when the sentiments around the sector were low, commodity prices were at the bottom, and valuations were in favor. On the pharma sector, basis this framework, we believe that the sector is a contrarian buy today. Popularity is at multi-year low, sentiments are beaten down, and valuations are at discount to long period average. A perfect cocktail for a contrarian investor. And lastly, on IT sector, we believe it is not as it a case for contrarian investing, as valuations are still not at a discount to long period average and they are slightly expensive on a PEG basis. Thank you. For any query, please feel free to contact me.